The dollar has survived wars, recessions, and financial crises for over 80 years as the world's reserve currency. But there's one force it might not survive: the Middle East. Not because of terrorism or religious conflict, but because of something far more dangerous: oil, and the decision by Middle Eastern nations to stop pricing it in dollars. For 50 years, every barrel of oil sold anywhere in the world has been priced in US dollars. This created artificial global demand for dollars that allowed America to print unlimited money without immediate consequences. It's called the petrodollar system, and it's the foundation of American economic power. But that system is collapsing right now. Saudi Arabia, the linchpin of the entire arrangement, just ended its 50-year agreement to price oil exclusively in dollars. The United Arab Emirates is accepting yuan for oil sales to China. Iran sells oil in euros, yuan, and rubles. Even Kuwait and Qatar are exploring alternatives. When the Middle East stops pricing oil in dollars, the global demand for dollars collapses. When that demand collapses, the value of every dollar in existence crashes. And when the dollar crashes, it takes down the entire American financial system with it. This isn't speculation. This is cause and effect. The process has already begun. This is the story of how the petrodollar system was created, why it's ending now, and what happens when the Middle East triggers the final dollar crash. Let's start with how we got here, because understanding the petrodollar system is understanding why America has been so involved in the Middle East for the last 50 years. In 1971, President Richard Nixon made a decision that changed everything. He closed the gold window. For 27 years since the Bretton Woods Conference in 1944, the US dollar had been backed by gold. Foreign governments could exchange dollars for gold at a fixed rate of $35 per ounce. This gold backing gave the dollar credibility as the world's reserve currency. But by 1971, America had printed far more dollars than it had gold to back them. The Vietnam War, Great Society programs, and military spending around the world required massive amounts of money. Rather than raise taxes or cut spending, the government just printed more dollars. France, under Charles de Gaulle, figured this out. They started demanding gold in exchange for their dollars. Other nations followed. America's gold reserves were draining rapidly. Nixon had two choices: stop printing money and let the economy crash into recession, or abandon gold backing and make the dollar a pure fiat currency backed by nothing but trust. He chose fiat. On August 15, 1971, Nixon announced that the United States would no longer convert dollars to gold. The gold window was closed. The dollar became a faith-based currency. This created an immediate problem. If the dollar wasn't backed by gold anymore, why would foreign nations continue using it for trade? Why would they hold dollars as reserves? Without gold backing, the dollar was just paper. Its value depended entirely on confidence, and confidence was shaken. The solution came from Saudi Arabia and oil. In 1973, the Yom Kippur War triggered the Arab oil embargo. OPEC nations, led by Saudi Arabia, stopped selling oil to countries that supported Israel in the war. Oil prices quadrupled almost overnight. Western economies went into crisis: gas lines, inflation, economic stagnation. But this crisis also created an opportunity. The United States needed Saudi Arabia to keep selling oil. Saudi Arabia needed protection from regional threats and buyers for their oil. So they made a deal. The exact details of the 1974 agreement between the United States and Saudi Arabia remain partially classified, but the core elements are well documented. Saudi Arabia would price all of its oil sales in US dollars exclusively. OPEC, which Saudi Arabia dominated, would follow suit and price all oil in dollars. Saudi Arabia would invest its oil revenues in U.S. Treasury bonds, lending money back to the American government. In exchange, the United States would provide military protection to Saudi Arabia, sell them advanced weapons, and guarantee the security of the Saudi regime. This was the birth of the petrodollar system, and it was brilliant from America's perspective. Here's why. Oil is the most traded commodity on Earth. Every nation needs it. Planes can't fly without it. Trucks can't drive without it. Factories can't operate without it. Militaries can't function without it. And after 1974, you could only buy oil with US dollars.
If you were Japan and you needed oil, you had to buy dollars first. If you were Germany, you had to buy dollars first. If you were China, India, Brazil, anywhere, you needed dollars to buy oil. This created permanent, structural, global demand for US dollars. Every country needed to hold large reserves of dollars just to ensure they could buy oil. And where do you get dollars? You sell goods to America. You export products to the United States, earn dollars, and then use those dollars to buy oil. Or you buy U.S. Treasury bonds, which are denominated in dollars. This system allowed the United States to run massive trade deficits without consequence. America could import far more than it exported because other nations needed to earn dollars to buy oil. The petrodollar system also allowed the Federal Reserve to print unlimited amounts of money without immediate inflation. Normally, if you print too much of your currency, it loses value and you get inflation. But because there was constant global demand for dollars to buy oil, the excess dollars were absorbed internationally. Other countries held those dollars in reserves or used them for oil purchases. The inflation was exported. For 50 years, this system has been the foundation of American power. It allowed the United States to maintain a military presence in over 70 countries. It allowed the government to run trillion-dollar deficits year after year. It allowed Americans to live beyond their means, importing cheap goods and paying with dollars that cost nothing to print. But the system only works if oil is priced in dollars. The moment oil can be purchased in other currencies, the demand for dollars collapses, and that's exactly what's happening now. Let's trace the cracks that have been forming in the petrodollar system over the last 20 years, because this didn't happen overnight. It's been a slow erosion, and it's accelerating. In 2000, Saddam Hussein made an announcement that terrified Washington. Iraq would begin pricing its oil in euros instead of dollars. This was a direct challenge to the petrodollar system. If other OPEC nations followed Iraq's lead, the dollar's dominance would be threatened. In 2003, the United States invaded Iraq. The official reasons were weapons of mass destruction and ties to terrorism. No weapons of mass destruction were found. The terrorism links were dubious. But one of the first acts of the new Iraqi government installed by the United States was switching oil sales back to dollars. In 2009, Muammar Gaddafi of Libya proposed creating a gold-backed African currency called the gold dinar. He wanted African and Middle Eastern nations to sell oil for gold dinars instead of dollars or euros. Gaddafi had the resources to make this happen. Libya had large gold reserves and significant oil production. He was actively lobbying other African leaders to join the plan. In 2011, NATO intervened in Libya's civil war. Gaddafi was overthrown and killed. Libya's gold reserves disappeared. The gold dinar plan died. Libya's oil sales returned to dollars. Again, the official reason for intervention was humanitarian, protecting civilians from a brutal dictator. But the timing of these interventions relative to challenges to the petrodollar system is striking. The pattern is clear. Nations that threaten the petrodollar system face consequences. But starting in the 2010s, the threats became too large to stop with military intervention. China and Russia, both nuclear powers, began actively working to undermine dollar dominance, and they found willing partners in the Middle East. In 2012, China and the United Arab Emirates established a currency swap agreement, allowing direct trade in yuan and dirhams, bypassing the dollar. In 2017, China launched a yuan-denominated oil futures contract on the Shanghai International Energy Exchange. For the first time, there was a viable alternative market for pricing oil in a currency other than dollars.
By 2023, Saudi Arabia was in active discussions with China about pricing some oil sales in yuan. The Saudis were also discussing joining the BRICS coalition: Brazil, Russia, India, China, and South Africa, which is explicitly working to reduce dependence on the dollar. These aren't fringe nations. Saudi Arabia is the world's largest oil exporter. Their participation in de-dollarization efforts is existential for the petrodollar system. In June 2024, Saudi Arabia made the final move. The 50-year petrodollar agreement with the United States officially expired, and Saudi Arabia chose not to renew it. This wasn't announced with a press conference or major headlines. It happened quietly, but the implications are enormous. Saudi Arabia is now free to accept payment for oil in any currency: yuan, euros, yen, rupees, even gold. The Saudis haven't completely abandoned the dollar. Most of their oil sales are still denominated in dollars because that's what buyers are used to, and because the financial infrastructure is
already built around it. But the exclusivity is gone. The requirement is gone. And once the requirement disappears, the incentive to hold dollars weakens dramatically. Other Middle Eastern nations are following Saudi Arabia's lead. The UAE accepts yuan for oil sales to China, which is now the world's largest oil importer. Iran, under U.S. sanctions, has been forced to sell oil in currencies other than dollars for years. They accept euros, yuan, rubles, and barter arrangements. Russia, also under sanctions, sells oil to India in rupees and to China in yuan. Even nations that remain U.S. allies are diversifying. Kuwait has discussed pricing oil in a basket of currencies. Qatar is exploring yuan-denominated natural gas contracts with China. The trend is unmistakable. The Middle East is moving away from dollar exclusivity, and this creates a doom loop for the dollar. Here's how the doom loop works. As Middle Eastern nations accept other currencies for oil, buyers no longer need to hold as many dollars in reserve. China can buy oil from Saudi Arabia with yuan. India can buy oil from Russia with rupees. European nations can buy oil from the UAE with euros. The global demand for dollars declines. As demand for dollars declines, the value of the dollar falls. When the dollar falls, it takes more dollars to buy the same amount of oil, which means oil prices in dollar terms rise. Rising oil prices in dollars accelerate inflation in the United States. The Federal Reserve has to choose between printing more money to stabilize the economy, which causes more inflation and further dollar devaluation, or raising interest rates, which crashes the economy into recession. Either choice weakens the dollar further. And as the dollar weakens, more nations abandon it for oil purchases, which accelerates the cycle. This is the doom loop. Once it starts, it's very difficult to stop, and we're already in the early stages. Let's talk about what happens when this accelerates, because the collapse of the petrodollar system doesn't just mean the dollar loses value. It means the entire architecture of American power collapses. The United States has been able to run massive trade deficits for 50 years. In 2023, the trade deficit was over $800 billion. America imports far more than it exports. Normally, this would cause the currency to collapse, but it hasn't because foreign nations need dollars to buy oil, so they're willing to hold dollars and buy treasury bonds despite the deficits. When the petrodollar system ends, foreign nations don't need to hold as many dollars. They don't need to buy as many treasury bonds. Demand for U.S. debt falls. When demand for U.S. debt falls, interest rates rise. The U.S. government currently pays over $1 trillion per year just in interest on the national debt. If interest rates rise even 2 to 3 percentage points, that interest payment could double to $2 trillion annually. At that point, interest on the debt becomes the single largest item in the federal budget, larger than defense, larger than Social Security, larger than Medicare. The government has to choose between defaulting on the debt, cutting spending drastically, or printing massive amounts of money to pay the interest. Default destroys confidence in U.S. bonds permanently. Spending cuts during a crisis cause economic depression. printing money causes hyperinflation. There's no good option once you reach that point, and we're heading there rapidly. The Congressional Budget Office projects that by 2030, interest payments on the debt will exceed $1.4 trillion annually, assuming interest rates stay relatively stable. If rates rise due to falling demand for Treasury bonds, that number could reach $2 to $3 trillion. Let's also consider what happens to the dollar's value when oil is priced in multiple currencies. Right now, central banks around the world hold about 58% of their reserves in dollars. That's down from over 70% in 2000, but it's still dominant. They hold dollars because they need them for oil purchases and because dollar-denominated assets, mainly treasury bonds, are considered safe. When oil can be purchased in yuan, euros, or other currencies, the need to hold dollars drops dramatically. Central banks will diversify their reserves. They'll sell treasury bonds and buy Chinese bonds, European bonds, gold, or other assets. This is already happening. China's central bank has been buying gold aggressively, adding over 400 tons in the last 2 years. Russia's central bank has reduced its dollar reserves from 40% to less than 10% of total reserves. When central banks sell treasury bonds, the price of bonds falls and yields rise. Higher yields mean higher interest costs for the U.S. government, which accelerates the debt crisis. And when foreign central banks sell dollars to diversify, the dollar's value falls, which makes imports more expensive for Americans.
The United States imports about $3 trillion worth of goods annually. If the dollar falls 20% in value, those imports become 20% more expensive. That's direct inflation hitting every American consumer. Gas prices rise, food prices rise, because much of our food is imported or depends on imported inputs. Electronics, clothing, cars, everything gets more expensive. The Federal Reserve will face impossible choices. Do they raise interest rates to defend the dollar's value? That crashes the economy and causes mass unemployment. Do they keep rates low and let inflation run? That destroys savings and purchasing power. Do they print money to buy treasury bonds that foreign central banks are selling? That's called monetizing the debt, and it's the path to hyperinflation. Let me give you a specific scenario of how this could play out over the next 5 to 10 years. It's not prediction, it's extrapolation based on current trends. In 2025 through 2027, more Middle Eastern oil sales shift to non-dollar currencies. China expands its yuan-denominated oil futures market. India negotiates rupee-based oil purchases. The European Union explores euro-denominated energy contracts with Gulf states. Dollar reserves held by central banks decline from 58% to 50% of global reserves. The U.S. trade deficit remains large, but foreign appetite for treasury bonds weakens. Interest rates on 10-year treasury bonds rise from current levels of around 4 to 5% to 6 to 7%. The federal government's annual interest payment on the debt rises from $1 trillion to $1.5 trillion. In 2028 through 2030, a crisis trigger event occurs. Maybe it's another banking crisis. Maybe it's a major geopolitical conflict. Maybe it's simply a failed treasury auction where there aren't enough buyers for U.S. bonds. Whatever the trigger, confidence in the dollar breaks. Foreign central banks accelerate their shift out of dollars. Treasury bond prices collapse. Yields spike to 8 to 10%. The dollar loses 30 to 40% of its value against major currencies. Inflation in the United States hits double digits. Gas prices reach $7 to $10 per gallon. Food costs double within 2 years. The Federal Reserve is forced to choose between hyperinflation or depression. They choose to raise interest rates dramatically, similar to Paul Volcker in the early 1980s. Mortgage rates hit 12 to 15%. The housing market crashes. Stock markets fall 50 to 60%. Unemployment rises to 12 to 15%. The government can't afford the interest on the debt at these rates. They're forced to either default selectively on certain obligations, restructure the debt, or return to massive money printing despite inflation. The economy enters a stagflation crisis worse than the 1970s, and the political consequences are severe and unpredictable. In 2031 and beyond, a new international monetary system emerges. The dollar is no longer the dominant reserve currency. It becomes one of several reserve currencies, sharing status with the yuan, euro, and possibly a gold-backed or commodity-backed currency. The BRICS nations formalize an alternative to the dollar system. Middle Eastern nations price oil in a basket of currencies. No single currency dominates. The United States adjusts to being a normal country that can't print money without consequences, can't run unlimited deficits, and can't maintain a global military empire. The standard of living for Americans declines significantly as the country can no longer live beyond its means. Imports become expensive. The government cuts spending on everything from military to social programs. The adjustment is painful and takes a generation. This isn't inevitable, but it's the path we're currently on, and the Middle East is the catalyst because oil is the commodity that created dollar dominance, and oil is the commodity that will end it. Let's talk about what the U.S. government could theoretically do to prevent this, and why they probably won't do any of it. Option 1. Balance the budget and reduce the debt. If the United States could run surpluses and pay down the national debt, confidence in the dollar would increase. But this would require cutting spending by $2 trillion annually, or raising taxes by $2 trillion annually, or some combination. Politically, this is impossible. Neither party will cut entitlements or defense significantly. Neither party will raise taxes enough to close the deficit. Option 2, return to a gold-backed or commodity-backed dollar. This would restore confidence in the currency by tying it to something tangible. But the U.S. doesn't have enough gold to back the current money supply. At current gold prices around $2,000 per ounce, the U.S. holds about $600 billion worth of gold. The M2 money supply, which includes cash and bank deposits, is over $21 trillion. There's no way to back that with existing gold reserves unless gold was revalued to $70,000 per ounce or higher, which would be chaotic.
Option 3. Negotiate a new international monetary agreement similar to Bretton Woods. The U.S. could try to establish a new global reserve system that maintains dollar dominance through multilateral agreement rather than oil. But other nations, particularly China, have no incentive to agree to a system that benefits America at their expense. China wants the yuan to be a reserve currency. They won't help prop up the dollar. Option 4. Maintain Middle Eastern alliances at any cost. The U.S. could try to offer Saudi Arabia and other Gulf states new security guarantees, weapons deals, or other incentives to keep pricing oil in dollars. But the Saudis are already diversifying their relationships. They're building closer ties with China, which is their largest oil customer. They're hedging their bets. And the U.S. can't offer more military protection than it already provides without getting dragged into more Middle Eastern conflicts that are politically unpopular at home. The reality is that none of these options are likely to be pursued with enough seriousness to change the trajectory. The debt will keep growing, the deficits will continue, the Middle East will keep diversifying away from dollars, and the doom loop will accelerate. So what does this mean for you? How do you protect yourself when the petrodollar system collapses and the dollar loses significant value? First, understand that dollar-denominated assets will lose purchasing power. Cash savings will be worth less. Bonds will lose value as interest rates rise. Any wealth held in dollars will erode. Second, consider hard assets. Real estate, though it will crash initially during a recession, tends to hold value better than currency during inflation. Commodities like gold and silver have historically preserved wealth during currency crises. Productive assets, businesses, farmland, things that generate real value are better than paper assets during monetary collapse. Third, reduce debt where possible, especially variable rate debt. If interest rates spike, variable rate mortgages and credit cards become crushing burdens. Fixed rate debt becomes easier to pay off as inflation rises because you're paying back with devalued dollars, but variable rate debt gets more expensive. Fourth, diversify internationally if you can. Holding some assets in foreign currencies, owning property outside the United States, or having skills that are valuable globally can provide options if the U.S. economy enters a prolonged crisis. But most importantly, understand what's happening. The petrodollar system is ending. It's not a conspiracy theory. It's documented fact. Saudi Arabia ended the exclusive dollar agreement. Middle Eastern nations are accepting other currencies. Global dollar reserves are declining. The trends are clear. The Middle East isn't triggering the dollar crash because they hate America. They're making rational economic decisions based on their own interests. China is their largest customer. China wants to pay in yuan. Saudi Arabia wants Chinese investment in technology. The relationship makes sense for both sides, and it doesn't require dollars. The United States built an empire on the petrodollar system. For 50 years, it allowed America to print unlimited money, run unlimited deficits, and maintain global military dominance. But that system depended on Middle Eastern cooperation, and that cooperation is ending, not through war, not through terrorism, but through simple economics. The incentives that held the system together are gone. When the full collapse comes, it will be fast. Just like the 2008 financial crisis seemed to come out of nowhere, but was actually the result of years of building pressure, the dollar crisis will seem sudden, but will have been building for decades. The trigger will be some event that breaks confidence, maybe a failed treasury auction, maybe a major bank failure, maybe a geopolitical crisis. But once confidence breaks, the cascade will be unstoppable. Foreign central banks will dump treasury bonds, the dollar will plunge, inflation will spike, interest rates will soar. The government will face impossible choices, and the American standard of living will adjust downward to match the new reality that we can't print prosperity forever. The Middle East holds the key because they control the commodity that created dollar dominance, and they're unlocking that door right now. The final dollar crash isn't coming because of bad policy, though that's part of it. It's coming because the fundamental structure that supported dollar dominance, oil priced exclusively in dollars, is disappearing. 50 years ago, Henry Kissinger and Saudi Arabia created the petrodollar system. It was brilliant. It gave America decades of unparalleled power and prosperity. But nothing lasts forever, and the Middle East, which gave the dollar its dominance, is now taking it away. Not through war, not through terrorism, but through economics. They're simply choosing to accept other currencies for their oil, and that choice will bring down the most powerful currency in history.